In this video, I show you exactly how you find the best Forex pairs, the best stocks, and in general, the best charts to trade every single day. So let's get started. And we cannot predict. This is not the job of a trader. We are not here in the prediction business. But we have to assume that what has happened on the left on our price charts will with some likelihood also play out again on the right hand side. So what does it mean? So when you see that a trend has occurred or a trend has happened, the only thing that we know about this chart is what has happened on the left. So what has already happened. This is the only thing that traders have at their disposal. And we have to assume, otherwise we have nothing really to do here as a trader. We have to assume, and we have no other information, we have to assume that what has happened on the left will also repeat itself on the right hand side with some likelihood. Obviously not 100% because nothing in trading works 100%, but this is the assumption that we have to make. Otherwise we just can't do anything with price charts and with price action in general. So a trend will lead to, with some likelihood, not always, more trends. This is what we have to assume. And a range market will, with some likelihood, not always, also lead to a more ranging markets. This makes absolute sense. This should be common sense. And this is what we are building upon in this video. And this is true until a pattern is broken. Obviously, a market will go through different phases. There will be trends, there will be ranges. And in the previous video, I talked about pattern connectors. So patterns are usually the connections between trends and ranges and so on and so forth. But for now, when it comes to finding the best charts every single day, we have to assume that what has happened on the left will also play out again on the right. This is all we have as traders. So do you really want to trade such a market? And I always see people comment on my YouTube lives, or when they first join our premium membership or premium mentoring, then they ask me about random markets and random charts. And whenever I see something like this, that a trader wants to have an opinion on such a market like this, I always really strongly advise to have a much better scanning practice and to stay first of all away from such a market, because you will just get chewed up completely in such a sideways market. You can see there's no trend, there's no support and resistance, lots of volatility here. So definitely you don't want to trade such a market. And as I said, markets will go through different phases. So a trend will lead to, very often, not always, lead to new trends, and ranging will lead to more ranging. And this is the only thing that we have to assume as traders. If we cannot assume that, then all of our trading will be complete guesswork. But this has to be one of the pillars that we use when it comes to stacking confluence and to just analyzing charts. So if you are a trend trader and if you are a momentum trader, look for markets that have been trending. You can see the market started in a trend, which led to another trend, which led to another trend. And this is a basic assumption that we just have to accept as a fact. And I've been trading for 14 years. And this is one of my most important assumptions that I just have to bring to the table every single day. Otherwise, you pretty much have nothing to just base your analysis on. And if you are a technical trader, make sure that your charts pay attention to technicals. So I'm a technical trader. I use technical analysis. I trade patterns. I trade breakouts. I trade trends in general. And I use support and resistance and trend lines. So when I go through the pairs that I follow, I make sure that I screen out the ones where the market is really all over the place, like in this example, where you cannot find any support, there's no resistance, there are no trends, and you cannot use your tools. And this is very important, obviously. So if you are a technical trader and if you follow price action, you have to make sure that the market in the past, in the recent past most importantly, has also respected the technicals, because we have to assume that this will also happen going forward. So when you are trading in an early trend and you see the market is paying attention to support and resistance, that's a great starting point, because it can give us confidence that the market that we're looking at is actually working out and it's actually tradable based on our tools and our things that we have. So the question then is, how many pairs should you follow? And the biggest mistake that most amateur traders make is that they either follow too many or not enough markets. And the biggest problem is that when traders say, I want to specialize in trading the euro US dollar, or I only want to trade the British pound US dollar, and you will easily and immediately run into problems because, as I said, the markets and the pairs, they will go through different phases. A market or a Forex pair can stay in a range market for a long time. It can keep trending for a long time. And you want to make sure that you have a selection process that will help you filter out the ones that are not favoring your trading style. So as a day trader, stick to fewer pairs. As a day trader, maybe have 4, 5, 6 Forex pairs or markets that you generally follow. And as a swing trader, you should generally follow way more markets. The reason for that is, as a day trader, obviously you will have multiple candles in a day. You will often see the market go through different trending and range phases within a given day, or at least within a few days. So even if currently, let's say you're trading the 5-minute chart and the euro US dollar is stuck in a sideways range, it is not too much waiting required until the market is eventually going to trend again. So as a day trader, you may more easily sit out those phases where the market is just not favoring your trading style and is not showing the price action that you require. However, as a swing trader, this is a problem. Let's assume you're trading the 4-hour charts and you only have 6 candles in a day on a given Forex pair. And obviously, within 6 candles, not too much can happen, obviously. And if your Forex pair is stuck, let's assume you're trading a Forex pair and it is stuck within such a range, you can see this will take days and days and days, because every 4 candles represent 1 trading day. So if, let's assume this is a 4-hour chart and this is your Forex pair, I would immediately screen it out. I will not look at it again until the market has concisely broken out of such a range and started trending. And this is my scanning process, which I would really recommend to all traders. Adopt a scanning process. Adopt a process where every day in the morning, go through all of the Forex pairs that you watch, flag the ones that have favorable price action, that are looking good for you to trade, and keep those ones. And the ones that are not favoring your price action or your requirements, then just eliminate them. Don't look at them again until the end of the day. Or if you're a swing trader, this has to be true for a weekly scanning process. So every week or every 2 or 3 days, go through your Forex list, keep the ones that fit your strategy and that fit your requirements, and eliminate the ones that don't, because that will help you to just avoid looking at those charts where nothing happens for days and days. And this is obviously then a big issue. If you keep watching those markets where nothing happens, you easily get bored. And then out of boredom, out of frustration, you will just hit the buy button at one point because there's just nothing to do. And boredom usually always leads to bad trading decisions. So this is a scanning process that you should adopt to your trading. It will help you keep the markets that are favoring, that have favorable price action or just favorable market structures. You can use moving averages, for example, to help you with the screening process. This is what I do. I use specific moving average to just help me understand, is the market in a nice trending environment? How often has a moving average been broken? Is it still acceptable? And so on and so forth. And this will then help you find the best markets every single day. Obviously, nothing works 100% of the time, and even a nice trend will sometimes just then lead to a nasty range market. But that's the way of a trader. We never know 100% what will happen. The only thing that we can do is create assumptions, theories, and then test them and make sure that when something works out, write your winning trades, and when something doesn't work out, get out of your loss and make sure that you preserve your capital for the next opportunity.